You've been looking at the stock market over the last week. I hope you like the color red because that's exactly what it's been doing. The trade war that they started with Liberation Day has been absolutely crushing the stock market. And in today's video, I want to look at the economic forecast of what pros are saying over the next 2 weeks, possibly even 2025, and what we're going to see. Now, if we look back just the last couple days, the market endured the worst week since 2020. So it has been 5 years that we have seen the absolute worst week. S&P 500, which I do personally hold, lost 7% in the last 5 trading days. That is a massive decline. NASDAQ went right into bear market since 2022, seeing a big decline. But what could be coming next? A lot of people are saying that we should be bracing for a recession in the United States because of the tariffs. And if the tariffs do stay in place, what exactly is it going to look like? So with the tariffs in place, it is pushing the economy closer to a downturn, which is really the gauge or Liberation Day since it has happened, where it starts signaling that we see a weakening of the economy because of the tariffs. If we go into a massive trade war, it means that goods and services are going to be a lot more expensive, meaning that a lot of companies could be increasing prices. And it also opens the door for a lot of companies to be overvaluating or overpricing their goods and services just based on the possibility of the impact that the tariffs are going to have on production. Now, when we start thinking bigger picture, when we look at our tech companies, they're really trying to drive down the interest rate. Now, that ultimately is what President Trump has said, is he is using the trade wars to force the Federal Reserve to lower interest rates. And guess what? It is absolutely working. When we start looking at the announcement of the tariffs and looking at the recession risk, that went over 40%. They are saying now the risk of a coming recession in 2025, according to JP Morgan Chase, is saying 60%, which the prior estimate was 40. So right now it is at 60% looking at a upcoming recession in 2025. So they really quote and go into disruptive U.S. policies have been recognized as the biggest risk to global economies for the entire year and, of course, for the world in general. Trump administration's actions have been potentially not only the tipping point into taking us to a recession, but also affecting the global economy that we have. Now, then comes in the Federal Reserve. This is kind of the interesting point. When you look at steep rate cuts, we know when we started 2025, they were saying 7 rate cuts, then they went to 5, then people were saying 2. But with what we're seeing right now, the Fed could react to economic weakness by cutting those interest rates even faster than the market has expected to keep inflation under control. Now, when we start looking at this, it is back on the board for 4 to 5 rate cuts in 2025 will be the new baseline going into 2025. So again, if we start looking bigger picture, so if interest rates start coming down, that means goods and services could possibly get cheaper. And if you're looking to borrow money, now this is a point when you think of COVID, when we think of a lower rate environment, auto loans were cheaper, mortgages were cheaper, borrowing money was cheaper. Anything that you need to finance was incredibly cheap. But on the flip side of that, when banks and credit unions have very low rates, CD rates are non-existent and savings rates are the exact same, almost non-existent, meaning that if we're seeing rates going down, chances are that those rates, those CD rates, those high yield savings rates are going to completely disappear in the marketplace itself. Now, of course, it's kind of too early to call it. A lot of people are saying that the Fed needs to intervene a little bit sooner rather than later and seeing exactly how it plays out. Now, knowing Jerome Powell, it seems like he's kind of on the conservative side, but if they don't cut rates or even do it emergency, which some people have even said in the news, might risk a full-blown recession when trade tensions are not resolved. Now, this could also be changed a lot with the tariffs. So if the tariffs are adjusted, if the tariffs are changed, if they hold the tariffs for all of 2025, this is going to be an absolute game changer for the economy itself, making and seeing exactly how expensive things are going to do. Because as it sits right now, we are in a global economy. Most of the companies, when even you look at, let's say, the top 10, you start naming off Google and Apple, Nvidia, all of these companies not only operate in the United States, almost all of them, if not all of them, I believe at this point, it is all of them in the entirety, do work and operate outside of the United States, meaning getting different parts from different places. Even thinking of the automotive, now I live right north of Detroit, but thinking of the automotive sector, which goes hand in hand with Canada. Canada getting tariffed, and of course, in return, we are getting tariffed when a lot of cars are kind of completed between both countries, having plants in different locations and parts and services going between both places, making it and really creating it to be a lot more difficult. So what does it mean for the stock market? Investors are believing that the stock market is deteriorating a little bit, which could event or could have a prolonged trade war if these tariffs do stay in place. Now, they are saying in this article, the bull market is dead. It was destroyed by ideologically and self-inflicted wounds that we did with what we've seen. Revised the year-end target of the S&P 500 from 6,000 to 5,700. So again, they're thinking there is going to be either a little kind of stagflation, almost staying exactly where it's going to be. Now, when we start looking also at artificial intelligence, now we know this was a very, very big part, knowing what was coming out of China, looking at DeepSeek, looking at NVIDIA, looking at all of these companies that were really just kind of crazy about booming the last 2 years with AI, really driven by a big, big increase to the tech sector. The concept of taking the US back to the 1980 manufacturing days when these tariffs is a very bad science experiment. And this is, of course, it says this is the process that will cause an economic Armageddon across the entire world that could crush the absolute tech trade industry, AI revolutionary themed, and the industry overall, which is what an analyst said from Business Insider. So very interesting to see the take on it. Tech world depends on the supply chain, manufacturers, and delivering of products to consumers with the technical and technology products and the world at the lowest price. They can no longer do that. They can no longer deliver because of the tariffs that we're seeing right now. So what does it mean for your portfolio? What adjustments have you had? A lot of people pulling a lot of money out of that S&P 500. A lot of people worried about what is going to be coming in 2025. We have seen essentially a lot of money pulled out of the stock market, even seeing money pulled out of the crypto market, moving into treasury bonds. So treasury bonds, I'm still doing incredibly well. I know the yields were down a little, but with the movement and a lot of money going into treasury bonds, it almost forces the Federal Reserve to lower interest rates, knowing that inflation could have a really big impact, meaning we could see and kind of forcing the hand of the Federal Reserve to lower those interest rates to an acceptable level or a lower level than they even want to try to keep that inflation in check. Now, the jobs report came back, and of course, the number was very good in there. So when you start thinking of the individual kind of sections of the economy overall is doing pretty well. It's pretty strong. Don't know exactly what the effect, again, of these tariffs are going to be kind of big picture, and if they're going to force a market crash. Now, for me personally, this is a massive buying opportunity, even though we've seen a couple days with the market really pulling back. If I'm buying it at 5, 7, 10% off, absolutely, I am stocking up, and I am doing it through dollar cost averaging. That is the best way in sticking with my 3 ETF portfolio. When I start looking at the NASDAQ 100, when I start looking at the QQQM, I'm investing on it hand over fist at a really good discounted price, knowing that it might be a year, could be 2, could be 3, that we see kind of the stagflation, giving me the ability to accumulate a lot of my ETFs that I absolutely love to buy through that dollar cost averaging. And I do this every single week, building a portfolio, even though it looks red. A lot of people are cashing out of the market, and I really feel like it's going to be a big opportunity when the market rebounds. We are going to see a very, very strong high rebound. And even if the tariffs roll back, we are going to see the stock market on fire, knowing that everything else has been kind of put in place. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.